All right, guys, so here we are doing breakout session number 1. So following along, here is our handout here. So here's example number 1. It says on January 1st, the first day of the fiscal year, Designer Fabric Inc. issues a 5,000,000 6% 10-year bond that pays semi-annual interest of $150,000. And here you see them doing a calculation for you. And they receive cash of $5 million, excuse me. So it's asking us to journalize the entries to record the issuance of the bond, the first interest payment on June 30th, and then C, the payment of principal on maturity date of December 31st. Now, first off, we need to ask ourselves as we solve this question, is this bond being sold at a premium, a discount, or face amount? Okay, which one? There's no interest rates, right? Where's the interest rate? There's only one, right? This one. So how do I know if this particular bond is being paid at which one is which? How do I know, right? So the reason we know, or the reason hopefully you have come to the conclusion that it's being sold at face amount, right? And the reason why I know that this is being, sorry, I need to make this smaller. Here it is, okay. So the reason why this is going to be sold at face amount is because we issued this bond at $5 million, and we also received the full amount in which we have issued it for, right? So that just means that whatever was in the market was also the same amount that we were offering it for like the interest rate, right? So now it's up to the investor to decide which maybe company they enjoy or they have a better reputation, things of that nature, right? It comes down to personal preference. Now, A asks us to journalize the issuance of the bond. So we're doing it from the perspective of Designer Fabric Inc. Okay, so what that looks like for us is we're going to journalize the cash that we receive. So we're going to do a debit to cash that we receive of the $5 million. And then our credit is going to be to the liability that we have now created, which is called bonds payable, BP bonds payable. Okay. All right. So that takes care of A. Now B, right? B asks us to journalize the first interest payment on June 30th. Okay. So we should follow the rules of journal entries. I'm kind of skipping that, but sorry. So on June 30th, my journal entry to recognize the first interest payment, which is the $150,000, is going to be a debit to interest expense. And then, as I mentioned before, that's going to be $150,000. And then your credit is going to be to cash, because that is what I'm promising my investors, right? That is part of the agreement. Okay. All right. So C asks us to now journalize the payment of principal at maturity. So our bond is a 10-year bond, right? So at the end of 10 years, we need to repay this $5 million bond back. That is part of the agreement. So to journalize this, we're going to do a debit to bonds payable, right? We're paying off our liability in the amount of $5 million. And then our credit, what is decreasing is our cash, right? In the amount of $5 million. Okay. All right, so that solves that question. So if you guys have any questions on this, or you're stuck and you just didn't quite understand it, let me know or send me an email, okay?